Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. There is a war happening, the virus is still lingering, inflation is soaring, growth is slowing, and central banks are tightening. Are recession risks rising? To answer this, we turn to our proprietary Recession Probability Indicator, RPI. On this week's podcast, we discuss in detail how we constructed our ADCB RPI and what this indicator is telling us at this stage about the probability of a recession over the next 12 months. As the adage goes, when America sneezes, the world catches a cold. This states the importance of the US in the global economy and global financial markets. After all, the US remains the largest economy in the world. The US equities constitute 60% of the global equity market benchmarks, and the US dollar is 60% of the global FX reserves. We believe that US remains central to the global financial markets, and the recession there could mean systemic risk, while recession in other major economies could mean more localized risks. Therefore, we base our RPI on the US macro and sectoral data. Turning to the methodology of our RPI, we gathered data on 29 select variables with good predictive power across 7 different segments of macro, consumer, housing, business, corporate, financial market, and commodity markets. After cleaning the data and putting it through a series of transformation, we calculate a master indicator, that is our RPI, and 7 sector-wise indicators of recession probabilities. We also regroup the 29 variables into 3 subgroups of leading, coincident, and lagging indicators based on how and when they signal the probability of a recession. Our master RPI now indicates a recession probability of circa 36% after having risen over the past few months from the lowest level in its 42-year history. Even after the recent rise, the RPI is still close to some of the lowest points of the previous cycles. Key levels to watch on this indicator are 50, 60, 70, and 80%. A 50% level indicates an equal chance of a recession. A 60% level in the past coincided with the start of a recession. However, there were 2 exceptions, both in the previous cycle, that is, the one between 2009 and 2020, where the recession did not materialize despite the indicator moving above the 60% level. This perhaps indicates how the previous cycle endured an extended slow growth environment with a couple of marked growth slowdowns. However, a 70% level on our RPI confirms a recession without any exception. A peak level of about 80% for the RPI indicates a deeper recession. For the context, only the recessions of the 1980s and the global financial crisis of 2008-2009 had seen our RPI move above an 80% level before falling. Also worth noting that RPI tends to rise during the mid-cycle slowdown of an economic cycle but falls rather quickly. Looking at some of the sub-indices, the leading component of the indicator is currently a little more advanced than the master RPI and indicates a recession probability of circa 45% and continues to rise. The coincident indicator is slightly more muted and indicates a 30% probability but is still rising. The lagging indicator, however, is higher at 36% but is still falling from its post-pandemic highs. It's rather an unusual situation that the leading and coincident indicators are rising when the lagging indicator is still falling from its previous recession peak. This confirms our thesis of a faster moving cycle, which our regular listeners should be familiar with. Sector-wise RPIs are rising across the board, but we see a wide range of implied recession probabilities. For instance, the financial market variables indicate a 56% probability of a recession, while the business sector implied probability is 24%. Also, even within a sector, we see different data pointing to different recession probabilities and different trends. For example, looking at the New York Fed's recession probability indicator, which is based on the 10-year 3-month US Treasury yield curve slope, the recession probability remains low and is still falling from its previous peak. But the recession probability indicated by the yield curve slope of the 10-year 2-year segment has risen above 74% recently, indicating a higher chance of a recession. Turning to the consumer sector, we see huge discrepancies in the soft data there. Weaker readings on the University of Michigan consumer sentiment expectations indicate a rather higher probability of recession, while strong conference board consumer confidence indicates a lower probability. This is because the former survey focuses on inflation and its impact on consumer, while the latter focuses on employment, wages, and consumer behavior. All this indicates heightened uncertainty about the outlook, which is reflected in many measures, including the recent projections by the US Federal Open Market Committee. In summary, yes, the recession probabilities have risen recently, but from the lowest level in their 42-year history. Even after the recent rise, the RPI is still close to some of the lowest points of the previous cycles. Recession probabilities tend to rise during the mid-cycle slowdown of an economic cycle, which we did expect the global economy to experience this year. The divergence between leading, coincident, and lagging indicators point to the pace of this economic cycle, which we expect to be faster. Further, the disagreement between sectors and even between variables within sectors speaks volumes about the uncertainty. All this confirms our view that the global economy is currently experiencing an asynchronous mid-cycle slowdown of this faster moving cycle. Such phases in the past were usually associated with higher uncertainty and financial market volatility. However, as a cycle matures into a new normal, uncertainty should start to diminish and provide a reasonably clear path for financial markets. Yet, we will watch the recession risk closely and will keep you updated as the situation evolves. Thank you for listening. In case you like this podcast, please do share it with a friend or a colleague. For more information on what was discussed on this podcast and what rising recession risks mean to your portfolios, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Thank you once again. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.